6, 7 years ago, if you had asked institutional investors about data centers, other than the sort of early first movers, you probably would have got a lot of like, what's a data center?
Hello and welcome to Cool Vector. I'm David Snow, your host. And today we're joined by Jeff Eaton, a partner at 5 Point Infrastructure, and Greg MacKinnon, Director of Research for PREA, which is the Pension Real Estate Association. Greg and Jeff, welcome to Cool Vector. I'm very interested in the evolution of the capital base among institutional investors for the digital infrastructure asset class. This is, as we can all agree, a burgeoning asset class. It seems to be coming from other asset classes, or at least the capital is being allocated from real estate, from infrastructure, perhaps from private equity, and it's going into this massive global opportunity with data centers and more broadly defined as digital infrastructure. Since both of you are experts at the institutional investment world, give us some guidance on how you think the opportunity to invest in data centers and digital real estate is evolving, and what is the mindset of many of these institutional investors and how they might think about the asset class going forward. Jeff, from 5 Point Infrastructure, you are a longtime expert in the world of institutional investment. You have raised billions of dollars in capital for all kinds of strategies, real estate, infrastructure, energy. Give us a sense of the size and the maturity of what might be broadly called the real assets asset class.
Yeah, David, happy to help. I've been in the private capital markets advisory and fund placement business for nearly 20 years. Talked to you several times when I was at Eaton Partners. At Eaton, we evolved into a real asset powerhouse. 5 Point was actually a client of mine. While at Eaton, we saw the real asset class really grow. I always tell people, think of the evolution of a new asset class. It's sort of like when you start investing in stocks in your 20s, when you finally make a little bit of money, you start by doing mutual funds, maybe do index funds. As you get more experience, you may start making concentrated bets in certain subsets of the equity market, and then eventually you start making bets on individual stocks. It's a simple analogy, but it's also how I've seen institutional LPs evolve their investment in certain asset classes. Real assets, which I would define as strategies that are underpinned by hard tangible assets. So I think infrastructure, I think real estate, I think natural resources, I think commodities, metals and mining. Those are all various subsets of real assets. Today, there's probably $20 to $30 trillion of AUM invested in real asset strategies. Probably 3 to 6 trillion of that is in private real estate, and infrastructure is close behind, but growing probably anywhere from 1.5 to 3 trillion of AUM.
Greg, you are head of research for PREA, the Pension Real Estate Association. Data centers are kind of real estate. They're sort of adjacent and they're their own thing, but a lot of your members are being asked to invest into data centers. Many of them are interested in digital infrastructure broadly defined. But before we get into that topic, just help us understand the size and the scope of your membership. How much capital do they represent?
Well, thanks, David. Our members include both the institutional investors themselves, whether that be pensions or endowments, foundations, sovereign wealth funds, etc. Also investment managers and sort of service providers to the industry. A couple of years ago, we estimated that our members had about $800 billion in real estate AUM, and overall AUM across all asset classes was north of 10 trillion. So there's a lot of capital involved.
Well, let's get a little bit of a history lesson in real estate before we delve deeper into data centers. The real estate asset class is often described as being a mature asset class, or at least relatively mature. Where did real estate start out as an asset class that was investable for an institutional investor? And how did it make its way to being very accepted and a part of almost every major institutional portfolio?
It kind of goes back basically to the late 1970s. Insurance industry. So insurance companies have been involved in investing in real estate for years and years. They developed teams that did that. They sort of had the idea in the late 70s, well, maybe we get to manage capital on behalf of pension funds. It was slow going for a long time. Back in the late 1970s, real estate was something new for pension funds. Pension funds are conservative, not necessarily in terms of risk taking, but in terms of adapting to something new. For very good reasons, they have a fiduciary duty to their beneficiaries. They're not going to jump in the latest trends. And to make a long story short, it's a allocation across almost all institutional portfolios, running somewhere in the neighborhood of sort of 10% of the overall portfolio.
Jeff, from your perspective as someone who spent a lot of time with investors, helping them understand, for example, real estate, What does maturity look like for you, and how did it apply to real estate?
The typical pension fund has 12 to 20% of their total pension fund invested in real estate. And if you consider the fact that a lot of their investments are in public equities, public fixed income, it's by far the largest share of one's private investment, even much bigger than private equity. All the pension funds, all the endowments, all the institutional investors I've dealt with for the last 2 decades, that's the biggest part of their portfolio. As they mature, as they get more experience, as they get more confident, they start to make more concentrated bets. We can turn that into the conversation on data centers. Data center investing didn't really start till probably 10 or 12 years ago. For the last decade, we've seen specialist managers evolve and funds raised dedicated solely to data centers. A typical institutional investor, they start with a more diversified approach, and as they get more experience, more conviction, they make bigger bets and more concentrated bets.
Let's fast forward to the present. If we're talking about things in the news, data centers are certainly stealing the headlines. These are gigantic deals. They require a ton of capital. And not surprisingly, the institutional investment market is being eyed very seriously as a place where a lot of this capital necessary for growth is going to come from. Jeff, what are the institutional investors that you've known for years, for decades, what are they saying to you about data centers? How do they evaluate them? What bucket in their institutional portfolio do they think they belong in? Just what's the general sentiment out there?
Generally speaking, it's a very favorable view. There have been several LPs that have invested in this space for, again, going back a decade, including in very specialized managers focused on it. Like anything else, where you can see returns being generated, it attracts more attention. And a lot of these early data center investments have turned out very well for people. So now the investors that didn't get exposure earlier are sort of in a weird position. They want to get exposure, but then they're debating, is it overheated? Did I miss the chance? There's probably a lot of that thinking going on right now. The number of data center specific funds that are being raised today is probably 4x what it was even 3 years ago. So there's a lot more supply. And that supply is forming, supply managers is forming because managers see this as a space where investors are allocating money. But when you give an investor too many choices, that's not always necessarily a great thing. The big question is, can those returns continue to be generated? But I'd say generally speaking, there's significant interest in the space.
Greg, at PREA, where your members are largely investing in the food groups of real estate, multifamily, logistics, retail, and something called office that I think people used to invest in. What are people saying about data centers? Do they think it's adjacent to what they normally do? What's the general sentiment?
I mean, it's certainly adjacent to what they normally do. As a matter of fact, I would say it's sort of smack dab in the middle because to me, and maybe I'm biased coming out of the real estate sector, but data centers, are they infrastructure? Yes, they're infrastructure, but are they real estate? Yes, they're real estate. A data center is a structure. It's a building, a permanent building, or at least very, very long-lived. Somebody develops it, puts it up, has to meet zoning requirements. That's sort of the definition of real estate. And then you essentially lease out its use to somebody else, and you make your return that way. It's exactly the same way as an office building or a retail complex or apartment building works. And even under tax law, I mean, the biggest players in data centers right now are the 2 big REITs, Equinix and Digital Realty. They're considered REITs because the IRS has said what you hold is real estate. So even by tax law, data centers are real estate. In terms of sort of awareness of it, amongst investors, they are very aware and very interested right now. I would say it would be hard pressed to find a single head of real estate, an institutional investor now, who has not been thinking seriously about data centers, even if they haven't yet committed capital. They certainly are looking at the sector and hearing about it and trying to learn about it. And that has been a major change. 6-7 years ago, if you had asked institutional investors about data centers, other than the sort of early first movers, you probably would have got a lot of what's a data center? Or if they knew what it was, they'd say, well, I don't know, is that going to last very long? Can I convert it back to an office later if I have to, sort of thing? The last few years has shown that there is a sort of growing global demand for data center space and data center facilities. I think institutional investors take it very, very seriously. But as I said, for real estate in general, there's a learning curve. And everyone's talking about it. It's a very hot topic at all the industry events, including the sort of the PREA events. Everyone's learning about it, but it takes a while for an institutional investor to get to a point where they can actually sort of put capital to work. They really have to be comfortable that they understand the sector, they understand the ups and downs. And also they understand the managers they may be using to sort of commit that capital to the sector. Institutional investors that have gotten burned in the past, even in the very recent past, you think about life science facilities. They were very hot post-COVID. All these biopharm firms were looking for space. Everybody started developing life science buildings, to cater to that scientific crowd. And suddenly that space was overbuilt and, the values of the property started to go down. So there's some worry about will that happen with data centers as well.
But I think you can break data centers down into different categories. The historical data center was a building that was purchased and repurposed to be a data center, right? Somebody bought it, converted it a data center, and it's definitely a real estate investment, similar to an office building, right? You've got the land, you've got the building, and then you're getting rents, right? In the case of a data center, they cost a lot more to build or repurpose, but you're getting much higher rents. I would call that brownfield, right? Or in real estate world, that would be a value add opportunity, right? Now we're seeing greenfield opportunities. Greenfield is where you're buying raw land and you're building a data center from the ground up. You don't have any customers. You don't have any infrastructure in place. You probably have fiber nearby. You've got access to power. But greenfield tends to imply more risk, right? More returns, but there's more risk. You're building it and you're hoping you can occupy it, right? Most of these guys are trying to get a customer signed up before they do it, so they're mitigating the risk somehow, but they still have the permitting risk. They still got the construction risk, the cost risk, the timeline risk. To take on that risk, you've got to get better returns. And I think that's part of the dynamic we have now is a lot of those close to the city repurposed opportunities have already been done, and now it's greenfield. And that's the big proliferation of data center managers I'm seeing are focused on greenfield. That just causes an institutional investor to have to do even more work, right? Is it worth the extra 300 or 400 basis points for this extra risk that I'm taking?
The risk in the greenfield development sort of depends really on the particular type of data center you're looking at, because if it's, a sort of a hyperscale, wholesale sort of scenario where you're bringing in one client and sort of doing a build to suit, you're bringing in an OpenAI or a Meta or whoever, basically pre-lease long term. If it's sort of a co-location data center where, you're going to have to fill it up with 2 dozen or 3 dozen or 100 different clients to take up, the capacity of that data center, then that has a whole different sort of risk profile. It probably is riskier because of the lease up risk. Institutional investors have started to become more interested in the development aspect, sort of the greenfield development, because they're interested in the high return. I think one of the bottlenecks, though, and Jeff sort of has alluded to this, is the lack of expertise within the real estate sector with regards to data centers. They're experts in retail and multifamily office and industrial, and buying another office building or another strip center or something like that is second nature to them. It's hard for them to suddenly get into data centers because that's a different type of expertise. So really the institutional capital has to go to specialists. It has to be someone who specializes and really knows the data center sector very well. That's a limited number of managers that are out there right now.
Jeff, you're right in the middle of this, but this is a very multidisciplinary asset class, right? I mean, you need to understand the land. If it's greenfield, you need to understand the construction process. You definitely need to understand energy and power. Is this a challenge for investors that they maybe know part of the puzzle, but not the whole thing? And then let's also add in that they need to understand, where are they going to invest? Are they going to invest in the flat dirt with the expectation that they're ultimately going to be the owner of a working data center? Or is it better to just wait until the thing's built and then they buy in?
When I think of data centers, it's a pretty broad term. There's a lot that is involved in that, right? There's the people who can actually build the building. There's the people who can lease up the customers. They've got the relation with the customers. Then there's the people that, can find the land. They can get it permitted. There's the people that can actually build the infrastructure. I mean, at 5 Point, for instance, we are in the data center space, but we are not trying to build data centers. But we see an opportunity to focus on building the infrastructure. And specifically, we've got a big land position in West Texas where you've got cheap gas. We've got water through some other businesses we own. We recycle frack water. We've got the infrastructure to get the gas from the oil field to the power plant. So that's what we're focused on. And I venture to bet that we're going to get some interest from some data center investors, even though that's not really a data center investment. It's still exposure to the space. As this data center asset class matures, there are going to be a lot of derivative opportunities to invest around it. Whether it be in the fiber, right? Infrastructure firms, for instance, have been invested in fiber for a long time. They've been invested in power transmission. Even if you've allocated to data centers before, there's going to be other opportunities for you to get decent returns by having derivative exposure to the data center asset class.
Walk us through the steps that need to happen for a large U.S. pension fund to allocate to a new type of asset, to open up a new asset class, to make its first investment in a data center. Kind of bureaucratically, what needs to take place before that first check can be written?
It's an investor-specific question. Some investors are more nimble. They can move more quickly than others. So for instance, family offices could be nimble. They can pretty quickly say, hey, let's get exposure to that asset class. There's not a big bureaucratic process. Typically, that's the investment team pitches an idea to the family. The family says yes, and they start doing it. So now talk about endowments. They could be more nimble too. I'd venture to bet that some of the first investments in data centers from endowments were made out of an opportunistic bucket. So they've got an opportunistic bucket set aside where the team largely has discretion. Obviously, they still need to get investment committee approval to go after things that, they don't have approved allocations for. Public pension funds, some of the most sophisticated ones probably have that opportunistic bucket. Most often, though, they have to go through a rigorous allocation process, which can take 6 months, a year and a half, where they're doing research, they're getting consultant advice. Is this something we should think about? The reality is, especially if you're a sovereign wealth fund or a public pension fund, you're still going to have some level of bureaucracy that before you can make these kinds of decisions.
A state pension fund, they are exceedingly careful about getting into something that is relatively new for very good reasons. They have a fiduciary responsibility to the beneficiaries. Can't say, well, let's look at the last 30 years of returns of data centers, because data centers don't have 30 years of returns to look at. Then you have to start going out and deciding, with whom am I going to place my capital? What manager am I going to use to place my capital into the data center? And that's a long process of due diligence.
Some public pension funds, I would say, quite frankly, most of them have a preclusion from investing in first-time funds. So they have to literally see a fund manager be successful 1-2 times before they can even, consider that.
David, you mentioned sort of the four main food groups within real estate for institutional investors. And one of those is multifamily, so, apartment buildings. If you go back to the kind of early to mid 1980s, multifamily was a tiny, tiny little piece of a typical institutional portfolio, like about 2% or something like that of the real estate allocation. And the thought at the time was that's just not institutional. Institutions shouldn't be owning places where people sleep. It's going to be bad for headlines. We have to evict a little old lady and that sort of thing. But then gradually, and people became comfortable with that sector and sort of learned more about it and realized it could be a good part of an overall real estate portfolio. It sort of grew and grew and grew. Now it took 25, 30 years, but multifamily is now on average the second largest allocation within a real estate portfolio right after industrial. So it went from we don't invest in that at all to an extremely important part of the overall portfolio. And data centers, I don't want to predict the future because I don't know the future, but there's a very good chance, I think, that data centers will go through that same process, although probably at an accelerated rate. It's not going to take 25 years, but it is going to take a few years until, institutions generally are sort of comfortable with data centers and they've got to know the sector and they've got to know the managers they like and they've seen, managers be successful and they're comfortable investing with them.
Jeff, do you think that in the current market, a large, well-established brand name private capital firm, I don't need to name them, but the big brand name firms, are they going to have an advantage raising capital for data center and digital infrastructure strategies simply because they're known to these investors? They have a track record of dealing with very large amounts of capital and large projects. Or do you think that there is more of an advantage to the smaller, very specialized groups?
I see it both ways, David. Yes, the large brand name firms that have had institutional LP bases for a long time tend to always have an easier time raising money. If you put yourself in the shoes of someone at a pension fund, for instance, you're not going to get fired if you're investing in brand name X's 20th fund, right? Where you could get fired if you invest in whatever, Joe Schmo's first fund and it doesn't work out. So I think that's always going to be easier to raise money if you're an established firm that's got multiple Roman numerals of funds beneath you. That being said, some of the best returns come from investing in the first time fund. And so there's that tension there from the big institutional investors. Do I invest in the safe thing? Or even if it goes badly, I'm probably not going to get fired. Or do I take some chance, get better returns, but there's implied more risk there, right? They're really smart, sophisticated investors who've gotten used to taking risk. are doing more and more emerging managers because the empirical evidence shows that the returns are better. You do take more risk, but the returns are better. And the risk, by the way, you're taking isn't necessarily asset level risk. It's more organizational risk, right? Can the firm stay together? Big brand name firm, they experience turnover all the time. They replace somebody with someone else. But if you're a small team, you've got two key investment professionals, one of them leaves, that could be catastrophic for an emerging manager. That's the real risk that these institutions are trying to weigh. It's not necessarily the strategy risk, the asset risk. It's more the organizational risk. Can the organization survive for the 10 years that this fund's going to be alive?
There is a huge opportunity for data centers and digital infrastructure to drive the adoption and the growth of renewable energy, in large part because the customers of these data centers, the huge hyperscalers, Google, Amazon, want emission-free energy to their data centers. They know they can't have it now, but that's the goal in the long term. How do you see this playing out? Do you see a huge sort of adjacent opportunity for renewable energy? And is there an investment thesis that comes with that?
Renewables will play an important role. The problem with renewables at this stage is it can be very intermittent. And these data center operators have to have 100% certainty that they're not going to lose their power. You can supplement renewables with batteries. We believe strongly that other sources of power generation are going to be necessary. And that's why we're specifically focused on gas-fired generation. Gas is generally clean. We've got some infrastructure businesses that can capture and sequester the carbon and the other emissions. So we think we've got a pretty green alternative, even though it's gas-fired generation, will be part of the energy stack that these data centers need.
Excellent. Well, Greg MacKinnon, Director of Research with PREA, and Jeff Eaton, a partner at 5 Point Infrastructure. Thank you both for joining Cool Vector today. And I'd love to have you back to talk more about how this data center and digital infrastructure asset class is developing and maturing.
It was great, David. Thank you.